Is there potentially a very large problem for the stock market that's looming on the horizon and might be caused by the very popularity of index funds? Let's jump in and talk about this. I want to start with an article that was recently posted in Forbes. It's called Index Funds Surge in Popularity But Pose Risk for the Market. It was written by Chris Carosa. And Chris opens the article saying, John Bogle once said that index funds would never compromise more than half of the total mutual fund market. But you know what? Things that are never supposed to happen have a way of happening. According to CNBC, passive investing now accounts for a bigger percentage of the market than active investing. The total on hand for exchange-traded funds and notes, along with passively managed mutual funds, totaled $13.29 trillion at the end of December 2023, compared to $13.23 million for actively managed funds. Okay, so things that can't happen do happen, but let's continue with the Forbes article and see how this matters. How much can the market share of these investments, these passive index funds, grows? And what happens, Chris poses, to the market if that number hits 100%? It's not going to, but it's an interesting question. And more importantly, Chris says, how might this put your retirement savings at risk? Okay, so right now, index funds capture 53% of the market, according to Chris's. And prices would co-move much more with retail flows into the funds. And this person, Moriata, is saying he's not seeing that yet. He's not seeing what we're worried about yet. And what we're worried about is when index funds are buying stocks just based on their percentage that they make up in the index that they're following. For instance, an S&P 500 index. If a company represents 1% of that index, regardless of the price of that stock, the index fund is going to buy that stock. Whether the stock is overvalued or undervalued, they don't care. What they care is they need 1%. If the company is 1% of the index, they need to own 1% of that company. Let's go on. So how are prices set, and how is this impacted because of index funds? You know, it's not unusual if we look at the holdings of some big companies that are some of the top 20 positions in the S&P 500, it's not unusual to see that these companies represent 10 to 20%. The index funds, the passive index funds, hold 10 to 20% of that large company's outstanding stocks. I mean, these are big companies. These are companies in the Magnificent Seven. That accounts for about a third of the S&P 500. So with these very large companies, 10 to 20% of their shares are being held by these passive index funds. Companies like Microsoft, Alphabet, which used to be called Google, Amazon, Apple, Meta, Tesla, and NVIDIA. And I should have mentioned NVIDIA first because it's right now either at or close to the most valuable company in the world. So these 7 companies that the media calls they'll be the Magnificent Seven until they're not. There's 7 companies out of the 500 company index that is the S&P 500. So they represent less than 2% of the 500 companies. But guess what? Guess what percent that these companies represent from a market cap and exposure to the S&P 500? They're about one third of the total index. So if you buy the S&P 500, I should say none of this is financial advice. It's not investing advice. I don't know your situation. For the most part, I try not to even talk about individual stocks, but here I can't talk about the Magnificent Seven. I can't illustrate this issue without talking about the 7 largest companies. So these 7 largest companies represent less than 2% numerically of 500 companies, but they represent almost a third when you buy the S&P 500 of what you're buying of your exposure. So if you invested $300 in the S&P 500, about $100 is invested in those Magnificent Seven stocks. So So what's the challenge with this? Well, first, it's important that you're aware of this concentration. There are ways to get around it. There are exchange-traded funds that do an equal weight of the S&P 500. They've likely dramatically underperformed in recent months just because the Magnificent Seven companies have done so well. Now, have those companies done so well from a price standpoint because the index funds are buying them, or have they done so well because the companies are doing well? Well, so far, we're not seeing that the index funds are blocking what's called price discovery. What's a company worth? There's still plenty of people evaluating that. So in the case of the Magnificent Seven, they've seen a great increase in their stock price in the last 12 months, but they've equally seen impressive results on their operating side. So, and the concern with the index funds and the passive funds is what happens when that decouples? What happens when there's a time when company stock is being bought just because it's part of an index and there's nobody doing price discovery? That's what the concern is. And I think it's illustrated very nicely by an investor by the name of Michael Burry, who became famous. He made a ton of money during the financial crisis, 2007, 8, and 9. There was a movie about him, The Big Short. And Michael uses this analogy of a theater. When we go to see a movie, when we go to see a play, people come in at different times, so there's really not a crowd at the door to get into the theater, once the early birds get out of the way. And then the theater becomes full, and the movie starts playing. But what would happen if there was an emergency during the movie, right? We'd all run to the exits, and those doors are only so big. And so that's Michael's concern, is as investing in these passive funds become more and more popular, does there become an impact event that's like that emergency in a theater where everybody starts running for the doors to sell their ETFs? And when they go to sell their ETFs, the ETF holder, the company that runs that, doesn't have any choice. They have to start selling eventually. They have to start selling those positions. So even if companies are doing really well, they could be facing headwinds because of all this selling. So that's the concern. It is a risk on the horizon. Nobody knows. Right now, it's just a thought experiment. Nobody knows if it's a real risk or not. But I should mention that BlackRock, which is one of the largest providers of exchange-traded funds, recently put, a couple years ago, I should say, it was 2019, I believe, might be 2018, they came out with this article that says index investing supports price discovery. And here, what you see is their argument here, first off, is that while exchange-traded funds represent a large amount of the assets that are held, as far as the assets that are being traded on a daily basis, it has stayed pretty constant since 2014 to 2018 at about 4 to 6%. It stayed in that range. But it doesn't answer that theater question, what happens if everybody starts running for the doors and this becomes a larger percentage. But I do want to read you what they said about it. In reality, they say index funds add information to the market, that they support this price discovery. And they say, they give an example of what would happen if people wanted more exposure to emerging market equities, and to raise the money to do that, they wanted to sell the developed market equities. So sell U.S. companies to buy stock in a Vietnamese company, for example, in a developing nation. And what they say is that ETFs make it easier, more convenient, and less expensive for somebody to do that, because the tools that they otherwise would have if there weren't passive tools to allow them to do that would be more expensive and more difficult to make happen. So is there a challenge taking place right now? Is this a risk that takes place today? As Chris mentioned in his article on Forbes, talking about this on the horizon, and does it compose an issue for potential retirees? And I think right now we're not at that point yet. We may never get to that point, but it is something we all should be thinking about and aware of. And Chris ends his article by talking about the ultimate boundary condition where you're at 100% with the passive funds. And he says this advice is as old as Aristotle. The Greek philosopher considered moderation a virtue because it lies between the extremes. And he says that because we're not at an extreme yet. And just like this is a challenge that I want on your radar screen, there's another challenge that many viewers have, which is deciding when they should retire. And that's why I made this video up here. It's called Retiring at 65. It could be a big mistake. I'm basically encouraging people to think about retiring sooner so they can take full advantage of the youth of their senior years. Thanks for watching this video, and I'll see you in the next one.